Same protection, different contract. You have probably seen the word Takaful everywhere next to regular insurance plans. But what does it actually mean? Are you just paying for the exact same thing under a different name, or is there a fundamental shift in how your money is being handled? Let's break down what's actually happening behind the scene because the difference might surprise you. To understand Takaful, we have to look at where your money goes. In conventional insurance, you pay a premium straight to the insurance company. Once that money leaves your bank account, it belongs to them. They take the risk of paying out your claim, but they also pocket the profit if you stay perfectly healthy. Takaful completely flips this script. Instead of buying a policy from a company, you are entering a partnership with other participants. Your money doesn't go to a corporate bottom line. It goes into a shared risk pool called a tabarru fund, which basically means donation or contribution for the common good. So what does the Takaful operator do? They don't own the fund. They are simply hired managers. They run the day-to-day operation, process the claim, and ensure everything is Syariah compliant. In exchange, they charge a transparent management fee, often based on a mudharabah, which means profit sharing, or wakalah, which means agency model. You are not paying a corporation to take your risk. You are pooling your money with others to protect each other. Now, this structural difference leads to one of the coolest features of Takaful that conventional insurance simply cannot match: surplus sharing. Think about it this way. In regular insurance, if it's a good year and very few people make claim, the insurance company celebrates because their profits skyrocket. You just get a renewal notice for the next year. But in Takaful, remember the money in the tabarru fund belongs to the participant, not the operator. If the fund has a great year, the claims are low, and there's excess cash left over after paying everyone out, that money doesn't just vanish into a corporate vault. That surplus can actually be distributed back to the participants or used to reduce future contributions. It acts as a literal reward for a healthy collective community. If the pool wins, you win. Let's address the elephant in the room. Because Takaful is rooted in Islamic finance principle, a lot of non-Muslims assume it's not for them. This is a massive misconception. Takaful is open to absolutely everyone, regardless of your faith. At its core, it's just a highly ethical, community-focused financial model. And if you look at the actual benefit table, the coverage, and the pricing, Takaful plans are often structurally very similar to and highly competitive with conventional plans. You aren't sacrificing medical coverage, critical illness payout, or life benefits just to choose Takaful. The day-to-day utility is practically identical. The true difference lies entirely in the underlying contract and how the funds are ethically invested and managed. So which one is right for your portfolio? Whether you prefer the straightforward corporate risk transfer of conventional insurance or the cooperative ethical surplus sharing model of Takaful, the most critical step is making sure your coverage actually matches your real-life financial goals. Don't guess when it comes to your financial safety net. Let's figure out the exact structure that makes sense for you and your family. Head over to keithwong.my right now. Let's get your financial planning mapped out properly, transparently, and effectively. Thanks for watching, and I'll see you over at the website.